Welcome back to Skytech-Lens. In the summer of 2025, the Trump administration stunned the world by slapping a sweeping 39% tariff on Swiss gold. The move came seemingly out of nowhere, catching both financial markets and political observers off guard. For decades, gold had flowed freely between Switzerland and the United States, underpinning trust in the global financial system. Now, that trust was suddenly in question. The announcement, made by U.S. Customs and Border Protection, reclassified gold from a financial asset to a simple commodity, subjecting it to the highest import duty ever imposed on a developed nation. This bureaucratic shift sent shockwaves through the industry, as gold had always been treated as a special case, an asset above politics and trade disputes. Washington claimed the move was necessary to address a $48 billion trade deficit, accusing Swiss firms of exploiting the American market. Officials argued that the tariff would level the playing field, but critics saw it as a blunt instrument that risked far-reaching consequences. But targeting gold, a pillar of the global financial system, was a shocking escalation. Gold is more than just a commodity. It's a symbol of stability, a reserve for central banks, and a safe haven in times of crisis. The tariff hit the standard 1 kilogram and 1 ounce bars traded on the COMEX exchange, sending a clear message: economic nationalism had reached the heart of global finance. Traders and investors realized that even the most established markets were no longer immune to political intervention. The world had just 1 week to react before the tariff took effect. In that short window, banks, traders, and governments scrambled to assess the risks and devise contingency plans. Disbelief and panic swept through trading floors and central banks worldwide. Emergency meetings were called in Zurich, London, and New York, as officials tried to gauge the fallout. Gold futures soared to $3,134 per ounce as traders scrambled to price in the new reality. The sudden spike reflected not just supply concerns, but a deeper anxiety about the rules of global trade. The crisis threatened to disrupt supply chains, inflate borrowing costs, and challenge the supremacy of the US dollar. Investors worried that the ripple effects could reach far beyond gold, impacting currencies, interest rates, and even consumer prices. Switzerland, suddenly in a showdown with a superpower, faced a threat to its economic model and the stability of global finance. The Swiss government weighed its options, knowing that retaliation could escalate the crisis even further. The world watched, uncertain if this was a negotiating tactic or the start of a costly trade war. Analysts debated whether cooler heads would prevail, or if the standoff would spiral out of control. The shock was immediate, the consequences potentially seismic. Every corner of the financial world braced for aftershocks that could reshape the global order. The gold market, and the world, held its breath, waiting to see what would happen next. To grasp the impact of the tariff, you need to understand Switzerland's dominance in gold refining. This small, landlocked country has carved out a niche that no other nation can match. Though it mines almost no gold, Switzerland has become the epicenter of gold refining. Switzerland refines about 70% of the world's supply, a staggering figure that underscores its pivotal role in the global gold market. This gold is imported from over 100 countries, making Switzerland a global hub for gold processing. 4 massive refineries in the Alps transform raw gold into the high-purity bullion trusted by central banks and investors worldwide. These facilities are marvels of modern engineering and efficiency. Swiss gold bars are the global standard, known for their quality and purity. They are certified by the London Bullion Market Association and held by institutions like the U.S. Federal Reserve, ensuring their credibility. In early 2025, Swiss gold exports to the U.S. alone topped $36 billion, highlighting the immense value of this trade. No other country matches Switzerland's scale, speed, or reputation in gold refining. It's a unique position built over decades. Disrupting this flow isn't like switching coffee suppliers, it's like severing the world's main financial artery. The implications are far-reaching and severe. The U.S. tariff wasn't just a tax on luxury, it was a strategic move, with deep economic consequences. It was a direct hit to the core of the bullion market, causing ripples across the financial world. There's no quick substitute for Swiss gold. Its absence would create a vacuum that's hard to fill. The monopoly is built on infrastructure, trust, and decades of reliability. It's a system that can't be easily replicated. Without Swiss gold, the gears of global finance grind, leading to widespread uncertainty, creating uncertainty for everyone, including the U.S. The world quickly realized Swiss gold isn't just a product, it's a foundation. It underpins the stability of the global financial system. The tariff threatened to shake that foundation to its core, posing risks that extended far beyond mere economics. Markets reacted instantly to the Swiss gold tariff, sending shockwaves through trading floors around the world. Investors scrambled to make sense of the sudden move, and uncertainty rippled across every major financial hub. Gold futures on COMEX skyrocketed to $3,134 per ounce, driven by panic and the fear of a supply shock. The price surge was unprecedented, with traders describing the moment as a flashpoint for the entire commodities market. The tariff split the market in two, Swiss gold versus everything else. Suddenly, the origin of each gold bar mattered more than ever, and buyers were forced to rethink their strategies overnight. Industries from tech to jewelry braced for soaring costs and supply chaos. Manufacturers worried about delays, while retailers feared empty shelves and angry customers. The luxury sector, especially in states like New Jersey and Illinois, faced devastating job losses. High-end retailers closed their doors and thousands of workers were left in limbo, unsure when or if business would return to normal. The stability of the bullion market, once a given, was now in question. Analysts debated whether this was a temporary disruption or the start of a new era of volatility. In Switzerland, leaders scrambled for a diplomatic solution, while business groups warned of a major GDP hit. The country's reputation as a financial safe haven was suddenly at risk, and pressure mounted to resolve the crisis quickly. The U.S. action was seen as an existential threat to the Swiss economy. Headlines blared warnings of a looming recession, and Swiss citizens watched anxiously as events unfolded. Then, in a stunning reversal, President Trump abruptly scrapped the tariff via social media. The announcement caught even his closest advisors off guard, and markets struggled to process the news. Gold prices tumbled, but the damage was done. Confidence in the system was shaken. Investors wondered if stability could ever be taken for granted again. The episode exposed a deep vulnerability in global finance. It became clear that even the most established markets could be upended in an instant. Even the most stable assets were now at the mercy of unpredictable politics. The line between economics and geopolitics had blurred, leaving investors on edge. The world learned, no market is immune to geopolitical shocks, and the aftershocks of this event would be felt for years to come. The gold tariff shockwaves rippled through the U.S. economy. For the Federal Reserve, higher gold prices threatened to push up bond yields, raising borrowing costs for everyone. The Fed might have needed to inject billions into the repo markets just to keep liquidity flowing. Ironically, a stronger dollar from higher yields could worsen the trade deficit the tariff aimed to fix. America's own gold reserves, much of it Swiss refined, suddenly looked less secure. The policy exposed deep divisions. Mining lobbies pushed for more domestic gold, while manufacturers and jewelers warned of job losses and higher prices. The tariff's revenue was negligible compared to the risks it posed to financial stability. The crisis revealed a government torn between protectionism and economic reality. The gold tariff was short-lived, but the internal conflicts it exposed remain unresolved. The episode left scars on both Wall Street and Main Street. The lesson: economic nationalism can backfire fast. Switzerland didn't fold under pressure. President Karen Keller-Sutter led a diplomatic campaign, reminding the U.S. that gold was just one part of a complex relationship. Swiss leverage extended to pharmaceuticals, luxury goods, and precision instruments, critical to American supply chains. The Swiss also stood firm on banking secrecy, refusing to compromise on core principles. National unity backed this approach. Switzerland chose negotiation over retaliation, aiming for the diplomatic high ground. By linking gold to broader trade, Switzerland forced the U.S. to consider the full consequences of escalation. It was a masterclass in small-state diplomacy. Switzerland turned a potential weakness into real leverage. Diplomatic efforts intensified, but the gap between the U.S. and Switzerland only widened. President Keller-Sutter's trip to Washington failed to secure a meeting with President Trump, signaling U.S. intransigence. Switzerland offered to drop tariffs on U.S. goods and accept a lower gold tariff, but both proposals were rejected. The U.S. insisted on the full 39%, making clear its aim was punitive, not just economic. Switzerland chose patience, hoping to win international support by appearing reasonable. Swiss industry leaders grew frustrated as their access to the U.S. market hung in the balance. The deadlock revealed a clash of worldviews, rules-based diplomacy versus transactional power politics. The standoff left the global economy teetering on the edge of a trade war. The gold tariff deepened political divides in both countries. In the US, mining lobbies cheered the move, while jewelers and tech firms warned of disaster. Intense lobbying split Congress and the White House, pitting industry against industry. In Switzerland, debate raged over how to use potential tariff revenues, protect business or fund social programs. The crisis exposed ideological rifts, showing that even in a national emergency, consensus was elusive. The gold dispute became a mirror for deeper political tensions on both sides of the Atlantic. As the dust settled, both sides searched for a way out. Diplomats floated a compromise. The US would ease demands for gold origin certification, while Switzerland would share limited financial data. This deal would trim the trade deficit and preserve Swiss banking secrecy, but at a cost: a permanent compliance premium on gold. The alternative was a prolonged standoff, risking higher US borrowing costs and a blow to Swiss exports. Both economies needed a solution. The search for compromise was not just diplomatic, it was economic survival. The gold crisis forced both nations to confront the price of intransigence. The US-Swiss gold crisis left a lasting mark on global finance. It proved that in an age of economic nationalism, no asset or alliance is truly safe. The weaponization of tariffs against gold raised questions about the future of the global economic order. For Switzerland, it was a wake-up call about the risks of over-reliance on any one partner. For the US, it exposed the dangers of wielding economic power too bluntly. The world is left wondering, is this the new normal, or just a warning shot? The answers will shape the next era of global trade. Thanks for watching. Subscribe the channel for more updates.